It's Jason with Investing Logically. In this video I'll be discussing how you should invest in 2021. If you're new to this channel, I am a 19-year-old investor / college student, and the reason I made this channel was to educate others the importance of investing. Before I get to the video, I would appreciate if you all could sub to me and like the video if it helped you in any way. There are two main steps you need to take, in my opinion, that you should do before you invest. The first one is you got to pay off any debt, because since investing is for the long term, you don't want to use your investments to pay off debt, because you never know where the market's going to be in 5 months or a year, so you better pay off all your debt. That's the first step. The second step is that you should build an emergency fund worth 5 to 6 expenses. The reason for this is because you never know if there's going to be like another outbreak, COVID-19 outbreak, and you shouldn't be like using your investments to as an emergency fund. So that's really important. Well, there's going to be 3 main investments we're going to talk about. So the first one is called index funds. The next one is called individual stocks. The next one is called real estate / REITs. Before we get started, I just want to, when I talk about these 3 investments, I'll be rating them on the scale of risk, the reward, and how reliable. The first one is index funds. Index funds, or ETFs, are like exchange traded funds, which is like there's a manager who manages the funds in a basket of stocks. So it's not just one stock, it's like a bunch of stocks depending on the index fund or ETF. So this index funds are, in my opinion, they're not that risky, so I would give it a 4 out of 10 for risk. These index funds are managed by an investment advisor, so you have to pay an expense ratio for the manager to manage that fund for you. So let's say there's for example, index fund called ROTH, which is the S&P 500 index fund, which is basically Vanguard owns that fund, they manage it for you. They have an expense ratio of 0.07. They have an expense rate of 0.07. So for every $1,000 you invest, you'll pay 0.07% of the investment in fees for them to manage it each year. For example, since there's a lot of stocks in that fund, if one stock goes down, your fund won't go all the way down, it will just go a little, because there's other stocks that boosts up that fund up. If you guys going to invest in index funds, I would recommend do it in a Roth IRA, because that is tax-free, or you can do it through a commission-free brokerage called Robinhood. This is for the United States only. I'll be linking other brokers for other countries, like my country right now, and the UK and other countries across the globe. Open an account through Vanguard. So you just go to my account, go to investing, right? You go to open an account if you're in the USA, obviously. Then you open a Roth IRA. This is tax-free. So a Roth IRA is just like a retirement account that's tax-free. So that's nothing more. So you look, IRA, so this index fund. So basically what I'm saying, the expense ratio is 0.03%. So for every $1,000 you invest, there is a 0.03% expense ratio fee each year, dividend. So Vanguard, if you have this ETF, for every time they get the dividend, you get 1.5% of your investment in this ETF as a dividend. The growth over 10 years for this ETFs, so if you invested 10k in 2010, it would have been worth 36k in 2020. That is pretty good. Looking at the performance, it has gone an average of 1 year. 1 year is 18.35% return. That is quite incredible, because that is more than the average return. The average return is usually 8 to 12%, not including inflation, of course. So basically, this is a no-brainer investment. You can just invest $1,000 per year. Let's see this. You invest $1,000 per year. This one is called individual stocks. These are really risky. I would give it a risk rating of 8 out of 10, because if that stock falls down, let's say you invest in Tesla stock and it goes down to 0, you lose all your money. Whereas an index fund, if you invest in that and Tesla goes down, you do not lose all your money. I think if you do your research and you believe in the company, you believe in their fundamentals, you believe in what they do, it is not risky at all. So basically, Apple stock around last year was trading around $76 or $79.58. So if you put, let's say you put 1,000 in that, put 1,000 of that money in that time, over that year period, you would have made 74.75% return, which is basically nearly double, so around 1,800. Individual stocks is really a high risk, high reward. So if you do good, if you research the company well and it does good, then you'll get a lot of profit. If you're into like doing a lot of research and researching the company, looking at their fundamentals, then individual stocks could be for you. Okay, so next investment is called real estate. Real estate, you guys are familiar with it. So basically when you buy a property and you rent it out to a tenant and they pay you rent as free cash flow. Guys, this is an example of real estate. Let's say you buy this house for $1,375. You rent it out to a tenant, they pay you around $1,000 in rent per month. You get that rent every month. You hold this property for the long term, at least I would say 5 to 10 years. Then you sell it when the house increases, so maybe $2 million. And that is real estate. It is really high risk, high reward. I would give this risk rating around the same as stocks, 8 out of 10, because you never know where the real estate market's going to go in a couple of years. House prices could go down, interest rates could go up, which means more interest on your mortgages. You never know. So just make sure to do your research for real estate. Buy in the right area. So let's say there's an area in my country called Auckland. Auckland is one of the biggest cities in New Zealand. So basically Auckland is really populated. It's in the city, so it's quite expensive. So you might wanna, so if I were investing in real estate, I would pick Auckland because a lot of people are there. Even though it's expensive, there's gonna be more people looking for houses, more people wanting to rent out, such as, students, workers. Those are just examples. So yeah, however, there isn't a second choice if you don't have capital to invest in real estate, because you need at least a 10 to 20% deposit. An alternative to real estate could be REITs, which is real estate investment trust, which is basically a company buys the property for you and they pay you a dividend, which is basically they have an obligation to pay you a dividend of 90% of their earnings. That's correct, 90% of their earnings. It's required by law. Gives this risk level the same as real estate, 8 out of 10, and the same as stocks, because it's basically like a stock as well, called STAG, which is STAG Industrial, ticker symbol STAG. So what they do is they buy industrial property for you. So if you invest in this, they paid a 4.67 dividend each year. So that's pretty good actually. So if you don't have enough capital to buy physical real estate, REITs could be another option if you want cash flow. So if you invest 1,000 in this one, if you invest 1,000 in this company, you'll get around 1,450 in dividend income per year. Just so you guys know, please do your research before investing in REITs, because they could be really risky if you don't invest in the right one, such as the declining revenue. For example, if it's an AG&C, this is a REIT which pays an 8.95% dividend. That's pretty high, right? But you see, the stock price over the past couple of years has decreased, which means you're actually losing money. You're not gaining because the stock price is decreasing, not increasing. Do your own research before investing in REITs. They can be extremely risky if you don't do your research. As far as real estate goes, that is really a high risk, high reward. And for REITs, it's also high risk, high reward, because the dividend on those REITs are pretty high compared to other dividend stocks, which could be 2 to 3%, whereas REITs range from 4 to 10%. So that's the risk for these two investments. This is a bonus investment. So then the last investment I want to talk about is called investing in yourself. That's right, investing in yourself. This is an important one because you don't want to, because stocks, real estate, stocks, index funds don't make up who you are. So they don't make up your life. So you can invest in yourself. Believe in yourself. You can invest in yourself by making a business. Investing in yourself could mean acquiring skills to make a business, purchasing a gym membership to increase your physical well-being. There's a bunch of different ways you can invest in yourself. This is by far the most important, because if you don't invest in yourself, you don't know who you are. What is the point of investing in real estate, stocks, or REITs, or index funds? You gotta invest in yourself before you invest in anything else. Hope you guys enjoyed the video. Hope it educated you guys. Just so you guys know, all of my videos are not monetized, so I'm not earning any money on these videos. I probably just want to educate others on investments. That's all I want to do. So if you guys don't mind, and I hope you guys have a good day and happy investing. Jason with Investing Logically out. See you guys next time in the next video.